and gentlemen, we need to have a talk. And I actually took the liberty of typing this out because I didn't want to forget it. There's a lot of crazy recession indicators right now, and the markets are acting completely backwards. And we need to discuss it. Before we do, I just want to make sure that this is working okay. Cheers, my friends. God bless the hurricane victims, says Richard. I agree with you, my man. The federal government is not doing enough. FEMA's not doing enough. As a matter of fact, they're doing almost nothing but preventing Americans from actually helping. And that's a travesty, unlike any I've seen, actually. If you know a thing or two about September 11, well, maybe it's not so far-fetched after all. But we need to have a talk about a few things, specifically our markets right now, because it's all the markets. Guys, the housing prices right now are absolutely soaring. And it's happening as if interest rates didn't even exist. The dollar, the US dollar specifically, is strengthening like global economies are in perfect health. The prices of commodities is spiking as if the supply chains are collapsing again. And as some of you guys may know, due to the port strike, that's exactly what's happening. Real estate is booming, and inflation in most areas is a major threat, but real estate is pretending like it's not. The stock market is rallying like corporate profits are untouchable. And we all know what happens when this becomes the case. Emerging markets are falling, like global trade has come to a halt. Consumer spending is increasing. Like inflation doesn't matter. Even though the personal savings rate in America has collapsed to all-time lows. That's a big problem here. The corporate debt in this country is growing like low interest rates will last forever. And apparently, it's quite obvious that they're not. Defense stocks right now are rallying as though global conflict is inevitable. And you guys have seen what's going on right now in Israel, Ukraine, Iran, and so on. But retail stocks are shrinking like consumers have vanished overnight. Meanwhile, AI stocks are surging as if we've dodged a recession. Let's talk about gold and silver and oil, right? Because this is a major problem, you guys. Cheers, Sue. It's good to see you, my friend. Gold prices right now are climbing as though a recession is absolutely imminent. Oil prices are spiking as if we're on the brink of World War III, but they should be much higher. Bond prices right now are dropping as if geopolitical tensions are actually calming, and we all know that's not the case. Crypto is more volatile than ever, as if the risk appetite in this country has completely vanished. Hey John, it's good to see you, my friends. Cheers. Yeah, I live right around the corner as well. Tech stocks are soaring as if risk appetite is at an all-time high. Inflation right now in the Purchasing Managers Index, PMI, is starting to price in another rebound in inflation. Because today, the ISM non-manufacturing PMI data came in much hotter than expected. And in case you're not aware of exactly what that means, PMI data is inflation for purchasing managers at manufacturers and producers around the world. This was the hottest read we've had since January of 2023. CPI is not the only inflation reading we need to look at. And you guys are all well aware that there's a reason we call CPI CP-lie. For example, look at China right now. They are in absolute desperation as their property prices are crashing and the consumer sentiment in China is nearing record lows. They started the largest ever stimulus, including they cut the reserve requirements for their banks by 0.5%, 50 basis points, because banks were hurting so bad. They cut the 7-day reverse repo program operations rate by 0.2%. They lowered mortgage rates. China injected $142 billion into banks. That's an insane amount of money. $142 billion injected directly into banks. And they implemented these massive rate cuts because their entire economy is collapsing. The United States is following right in the footsteps of China. The markets right now in the US are pricing in a massive potential for a return of inflation. As I just told you guys about the ISM manufacturing data, the PMI index came out at levels that we have not seen since January of 2023, because a resurgence in inflation is coming. The Federal Reserve cut rates by 50 basis points this September 18th. And that was the largest surprise since 2008, on the exact same date that they cut them, which was September 18th of 2008. And of course, this year, September 18th of 2024. Stocks usually fall between 15 and 35% within the 12 months following the first Fed rate cut if there's a recession. CPI inflation has been perfectly tracking a 1970s trajectory. Look at this. I printed this out so you guys can see it, so I can show it to you specifically. Look at this chart. See the two lines there? One line is 1970s. The other line is today. Right about in the middle, you can see that they are exactly together. And one line cuts off. Because 1970 compared to today is the exact same thing. We've already started seeing the resurgence. And that's undeniable. This rebound in inflation that we're about to see at the end of 2024 and in 2025, throughout the entirety of 2025, will destroy consumer confidence, sadly. This is the kind of thing that we need to see in this country for markets to be properly priced and to be priced efficiently. Guys, if you weren't alive or paying attention in the 1970s, let's just say that things look exactly like they do today. And then inflation took off again, even higher, significantly higher than it was before. Oil prices right now are up over the last week on concerns that World War III is upon us. But they should be way higher than they currently are. Currently, XLE should be way above 100 already, but it's not. Why? If a soft landing is actually possible, guys, and wars are breaking out around the world, why are oil prices not over $100 right now per barrel? It's because markets are pricing in a major drop in demand. There's a huge drop in demand being priced in by markets for gasoline and oil because expectations of a recession are huge. The signals have been blaring for the last 24 months, but some people aren't paying attention. And the markets are purposely obfuscating these details. So as the volatility spikes, geopolitical tensions rise, and the Federal Reserve cuts these rates, Treasury yields should be down. But instead, you guys are probably acutely aware that U.S. Treasury yields are back on the rise, even after the Fed pivot has began. For example, look at mortgage rates right now. Mortgage rates today are higher than they were before the Federal Reserve cut rates. This is ass backwards. You should be pissed off, William. Everybody should be pissed off because it's too little too late. The recession's been upon us for a long time. And these examples that I just stated over the last 10 minutes highlight the contradictions and volatility that is often seen in these complex and unstable markets that we're currently seeing. The reason that nothing adds up is because the real world data does not align with the narrative by the Federal Reserve. Make sure you're properly hedged. Look at the price of gold. Look at the price of silver. They're pricing in a massive recession. Meanwhile, central banks are picking these precious metals up as if there's no tomorrow. Heavily shorted equities continue to be heavily shorted, including gold and silver. But the dark pools are being overwhelmed right now. There is not enough suppression available to them right now in gold and silver, meaning that there are other heavily shorted equities like the SLV ETF, other exchange traded funds, GOLD, other heavily shorted equities have to be pushed down in order for these guys to maintain their margin requirements. Companies with an absolute ton of cash on hand and greater profit margins that retail investors hold, like GameStop and AMC, are being crushed by shorts right now in order for the margin maintenance positions to be at the levels that they currently are, to prevent margin calls. The Federal Reserve had to meet with JP Morgan and the other banks to reduce the Basel III endgame initial margin requirements and reserve requirements to prevent them from getting margin called. Nothing lasts forever. No short can hold their position forever. Eventually, all shorts must close. All shorts must cover, one or the other. Whether it be silver, gold, GameStop, AMC, precious metals, shorts must cover their positions eventually. Mona Lisa says, breaking news right now. Iran just shut down its main oil refinery, preparing for Israeli attacks against them. China's going to be pissed. I got some news for you guys. About an hour ago, I purchased long calls on XLE. If you're unaware, XLE is the ETF tracking oil prices. I suspect that even though we are in a recession, demand is down because of Iran having to close some of their refineries and even some of their tanker loading areas. Oil prices will rise. Everything that you guys have seen right now going on with Hurricane Helene and the reduced amount of supply going to the southeast and the eastern states in the United States are all going to greatly reduce the GDP of this country. It is not good for the average American, the average consumer. But the reality is that even though there is less demand, the supply, due to things like Iran closing their refineries, as Mona Lisa just told us, Iran just shut down its main oil refinery, preparing for Israeli attacks against them. This is also going to negatively impact us here in the States in the terms of increased gas and oil prices. Gorilla Grodd brings up a great point in saying that Florida is bringing in the National Guard to protect and help keep ports running due to the strike. This is a massive challenge, and one that does not address the dozens and dozens of other ports in the United States, although you bring up a great point, Gorilla Grodd. I am personally the founder of several, meaning more than one, 8-figure logistics and freight brokerage and trucking companies. I have personally dealt with the shipment of millions and millions of dollars of goods coming in and out of ports, airports, drayage, ocean freight, air freight, etc., coming in from other countries. And just Florida alone being open, meanwhile all the other ports are closed, is insufficient to maintain sufficient levels of goods on grocery store shelves and store shelves in general to exceed demand here in the States. So with that being said, my friends, inflation will roar hotter. The Federal Reserve will have to cut rates more. You have to make sure that you are properly hedged. Because one way or another, this country's in for a rough time. Things are going to get worse before they get better. And the reason that I tell you this is so that you can be properly prepared. Canned goods is extremely important right now. Costco and even my local Aldi, Walmart too, are completely out of toilet paper. That is an exaggeration by the American consumer because they're stocking up on toilet paper in anticipation of shortages. Phil, for real, I hear you, my friend, and I agree with you. If you're properly hedged, you're going to do really effing well. If you're not, Lord help you, make sure you help yourself. Cheers, my friends. I wish you peace and wealth. If you're properly hedged, you're going to do just fine. And if you're very well hedged, you're very likely to be filthy fucking rich. Cheers. I wish you peace and wealth.